November 15th, 1923, Berlin. A gray morning that smelled of coal smoke and wet paper. The Reichsbank doors opened early, not to welcome depositors, but to move wheelbarrows. Inside them were banknotes stacked so high they bowed under their own weight. Outside, a clerk named Friedrich Müller waited in line with his wife. He had been paid at dawn. By noon, his wages would not buy a loaf of bread. By evening, the bakery would close its doors, not because it had sold out, but because the price had changed again. And no one knew what to charge. I begin here because this is where people misunderstand currency collapse. They imagine chaos arriving with sirens and gunfire. It rarely does. It arrives with paperwork, queues, and quiet humiliation. Friedrich did not think of himself as poor that morning. He had savings. He had a job. He had done everything right. By nightfall, his money was functionally dead. I have seen versions of this scene repeat across continents and decades. Different languages, same ending. In Weimar, Germany, the numbers are now recited like folklore. In January 1923, a loaf of bread cost 250 marks. By November, it cost 200 billion. The math is obscene, but the human experience was precise. Salaries paid twice a day, children sent to spend money before it decayed, lifetimes of discipline erased between breakfast and dinner. This was not madness, it was mechanics. Every currency collapse begins long before the public feels panic. It begins when a state confuses liquidity with solvency, when printing replaces production, when debt stops being a temporary bridge and becomes the road itself. The public does not see this phase. Investors do, but most dismiss it because markets still function, banks still open, and the screens still glow green. I learned early in my career that collapses do not announce themselves, they normalize themselves. In August 2008, I stood on a trading floor in New York, watching interbank spreads widen in a way I had not seen since. 1998, the numbers were small enough to ignore. Large enough to matter. People did ignore them. They always do. The story at the time was housing. The reality was liquidity. When liquidity goes, everything else follows. But let me return to Berlin, because history is the only teacher that never lies. The Weimar collapse followed stages. At first, prices rose, but wages rose too. People complained, then adapted. Then the currency weakened externally, but domestically life continued. This was the denial phase. Next came acceleration. Savings accounts stopped growing in real terms. Insurance policies became jokes. Pensioners noticed first. Then came velocity. Money stopped being held. It was spent immediately on anything. Furniture, coal, foreign currency, art, anything that was not the mark. The final stage was psychological. People stopped trusting numbers entirely. This pattern has repeated with chilling consistency. Harare, 2008. I remember reviewing inflation prints that were no longer annualized because the figures lost meaning. Trillions printed to pay civil servants. Shops closed not from shortage of goods, but from inability to price them. A teacher with a doctorate selling vegetables on the roadside because knowledge could not be eaten. The Zimbabwe dollar did not fail suddenly. It dissolved. Caracas, 2017. I walked through neighborhoods where the bolivar still existed in name, but not in function. Wages were paid, but survival came from remittances, barter, and assets accumulated before the collapse. The currency was used to pay bus fares, nothing else. Beirut 2020. Banks closed their doors with polite signage. Depositors were told to wait. Accounts still showed balances, but withdrawals were capped, then denied. People learned a new phrase, lollars, digital dollars that could not leave the system. Officially, nothing had collapsed. Practically, everything had. This is the stage most investors miss. Currency failure is not an event. It is a process. It begins with excess debt. It moves through monetization. It ends with loss of confidence. Somewhere in the middle, authorities insist they are in control. They always are, until they are not. What makes this dangerous is that it does not require incompetence or malice. It requires arithmetic. When obligations compound faster than productive capacity, the currency becomes the shock absorber. It must. There is no alternative mechanism large enough. As a macro investor, I have survived multiple cycles, not because I predict dates, but because I recognize sequences. This has happened before. It follows stages. Early warnings are dismissed as theoretical. Middle warnings are explained away as temporary. Late warnings are met with force. The title of this discussion is not provocative for effect. A liquidity crisis does not start when markets crash. It starts when marginal buyers disappear, when funding costs rise quietly, when central banks become the market, when price discovery becomes optional. By the time the public debates inflation versus transitory disinflation, the outcome is already constrained. In every collapse, there is an ordinary person like Friedrich, not reckless, not greedy, simply positioned in the wrong unit of account. Their tragedy is not ignorance, it is trust. In the chapters ahead, I will show you what survives when trust evaporates. Not theories, not slogans, assets that have endured Weimar, Zimbabwe, Venezuela, Lebanon, and others that do not make headlines anymore because collapse has become their baseline. I will explain why some instruments explode in nominal value but leave their holders poorer, and why others appear dull until the moment they matter. I will not offer comfort. Comfort is what destroys capital. For now, understand this currency collapse does not ask for permission. It does not care about intelligence, credentials, or intentions. It only respects structure. Those who recognize the pattern early do not panic. They reposition. Friedrich did not have that luxury. You do. I learned what the first survival asset truly was on September 21st, 1992. London was calm that morning. The pubs opened on time. The paper still printed the official line. But beneath the surface, sterling was bleeding. The Bank of England was defending a price that no longer existed. Rates were raised, then raised again. Billions were spent. It did not matter. By nightfall, the pound was out of the exchange rate mechanism, and a currency illusion had been punctured in real time. What survived that day was not cleverness. It was ownership of the right thing. Across every collapse I have studied or lived through, the first asset that survives is not exotic. It does not rely on leverage or promises. It is the simplest answer investors resist because it feels unsophisticated. It is hard money, money that cannot be printed, diluted, or politically negotiated. In Weimar Germany, gold did not soar because it became more valuable. It soared because the mark ceased to exist as a reliable unit of measurement. An ounce of gold in 1918 bought a quality men's suit. In 1923, that same ounce bought an entire apartment building in Berlin. The gold did not change. The currency did. This distinction matters because most people misunderstand survival assets as vehicles for profit. They are not. They are vehicles for continuity. They preserve purchasing power when the accounting system itself fails. In Zimbabwe, those who held gold dust, jewelry, or foreign hard currency did not become wealthy by local standards. They simply remained functional. While bank balances were wiped out, gold traded continuously in informal markets. It set prices when nothing else could. In Venezuela, physical gold mining surged, not because of speculation, but because it became a parallel monetary system. Gold paid for food. Gold paid for transport. Gold paid for safety. The bolivar became ceremonial. The mechanism is brutally simple. When confidence in a currency breaks, people do not stop needing money. They stop trusting the issuer. They search for a store of value that exists outside the political system. Gold has filled this role for 5,000 years, not because of mystique, but because it is scarce, inert, divisible, and universally recognized. Scarcity is the key. Gold supply grows at roughly 1% to 2% per year. No emergency meeting can change that. No election can accelerate it. This constraint is intolerable to governments in crisis, which is precisely why it works for investors. I have heard every objection. Gold has no yield. Gold just sits there. Gold is a relic. These arguments sound persuasive during stability. They collapse under stress. In Weimar, government bonds yielded astronomical nominal returns. They were worthless. Savings accounts paid interest. They were annihilated. Yield without integrity is a mirage. When the unit of account is failing, yield is noise. Another objection comes from those who point to confiscation. Yes, governments have attempted to seize gold. The United States did in 1933, so did others. But this argument confuses risk with inevitability. In every historical case, confiscation was partial, temporary, and porous. More importantly, confiscation occurred because gold mattered. No one confiscates what is irrelevant. Those who held gold through confiscation still preserved more purchasing power than those who trusted paper claims. Even when forced conversion occurred, it was typically at prices far below subsequent revaluation. Gold holders lost less. Everyone else lost everything. The deeper reason gold survives is psychological. In a collapse, trust contracts. People trust fewer institutions, fewer counterparties, fewer abstractions. Gold requires no promise. It settles transactions instantly. It does not depend on a clearinghouse that may close on Monday morning. During the Lebanese banking freeze, I watched depositors with substantial balances reduced to negotiated withdrawals in local currency at absurd exchange rates. Meanwhile, small gold dealers reopened within weeks. Pricing resumed there first, not in banks. This is the pattern. When formal systems cease, informal systems emerge. Gold sits at the center of that transition. Now, this is where discipline matters. Gold is not a trade. It is not something you lever. It is not something you chase for momentum. Those who treated it as a speculative instrument in past collapses often sold too early, seduced by nominal gains. The survivors were boring. They held. In my own framework, gold occupies a specific role. It is not a bet on apocalypse. It is insurance against arithmetic. When debt levels exceed what growth can service, when central banks become buyers of last resort, when liquidity replaces solvency, gold stops being an asset and starts being a reference point. I do not allocate everything to it. That is a mistake rooted in fear rather than analysis, but I allocate enough that if the monetary system changes character, my capital does not. The teaser most people want is a number. Percentages. Allocation. I will give that later, because allocation without understanding is how investors panic at the wrong moment. For now, understand the hierarchy. Gold is first, not because it makes you rich, but because it keeps you whole. In every collapse, there is a moment when people realize too late that their wealth was a number on a screen, dependent on permission. Gold holders never have that conversation. They already exited it. This is only the first layer. It preserves value, but it does not generate adaptability. For that, you need assets that operate inside the real economy even as currencies fail. Assets that benefit from distortion rather than merely endure it. That is where most fortunes are made or lost. The second lesson came to me not on a trading desk, but on a street corner in Buenos Aires in January 2002. The banks had frozen deposits weeks earlier. The peso had broken its peg. Middle-class professionals stood in lines that wrapped around shuttered branches, not to withdraw money, but to argue with tellers who could do nothing. Across the street, a butcher was open. His prices were written in chalk. They changed twice a day. He was not wealthy. He was solvent. This is where the distinction between nominal survival and real survival becomes clear. Gold preserves value, but it does not participate in the daily functioning of a broken economy. The next category of survival assets does. These are productive real assets that generate necessities people cannot postpone consuming. Across every currency collapse, three sectors reassert themselves with ruthless consistency: energy, food, and shelter. Not paper claims to them, control over them. In Argentina's collapse, farmland owners did not celebrate. They adapted. Grain exports were suddenly priced in dollars. Costs were local. Revenues were hard currency. Land values collapsed in pesos, then exploded. Those who understood this were not speculators. They were operators. In Zimbabwe, commercial farms that survived expropriation became islands of functionality. Fuel, maize, and labor were exchanged directly. The Zimbabwe dollar was an accounting fiction. Output was reality. In Venezuela, despite state interference and violence, privately controlled energy infrastructure that could still operate became the backbone of local economies. Diesel generators replaced grid power. Fuel, when available, was currency. The mechanism here is different from gold. These assets do not merely store value, they convert chaos into pricing power. When currencies fail, necessities do not become cheaper. They become more expensive, but more importantly, more strategic. This is where many investors get wiped out despite being right. They buy equities linked to these sectors without understanding balance sheets, political risk, or capital structure. They chase nominal returns that look spectacular while ignoring real purchasing power. I have seen energy stocks rise tenfold in collapsing currencies while shareholders starved in real terms. The chart looked heroic. The outcome was ruin. The survivors owned the asset itself, or equity with enforceable claims on production and pricing in hard terms. They owned things that could not be regulated into irrelevance overnight. In Weimar, Germany, urban real estate tied to rent controls failed. Rural land thrived. Why? Because food producers could bypass controls through barter and informal markets. Renters paid in goods. Landowners fed themselves first. This is where illusion enters. Nominal gains deceive the untrained eye. In Venezuela, the Caracas stock index rose millions of percent in bolivar terms. International headlines called it the world's best performing market. In dollar terms, it was catastrophic. Purchasing power collapsed. What matters is not how high a number goes, but what that number buys. The third survival asset sits adjacent to this reality: businesses with external revenues and local cost bases. Exporters, operators whose income is anchored to functional currencies while expenses decay. In every collapse, these entities experience an internal transfer of wealth. During the Asian financial crisis, Indonesian exporters survived, not because demand surged, but because their rupiah costs collapsed while dollar revenues held. The same dynamic replayed in Turkey repeatedly in Russia in 1998, in Argentina again and again. This is where discipline separates investors from gamblers. These assets look unattractive before the crisis. Margins are thin, politics are messy, but when liquidity breaks, they become asymmetric. Who gets wiped out? Salary earners paid in local currency. Bondholders locked into fixed payments, savers chasing yield inside the system. Who survives? Those positioned where prices reset daily and revenues float. There is a psychological toll here that markets never price. People cling to familiar instruments because they want normality to return. They hold bank stocks through nationalization. They hold bonds through restructuring. They wait for policy credibility that never comes back. I have watched intelligent investors ride currencies down because selling felt like betrayal. They were not wrong intellectually. They were wrong structurally. At this point in every collapse, the narrative fractures. Authorities speak of stabilization. Controls are introduced. Markets bifurcate into official and real. This is when the last window for rational repositioning closes. The retention hook for anyone listening is simple. Most damage does not happen at the peak of panic. It happens in the false calm, after the first shock, when people believe adaptation is over. It never is. Gold keeps you whole. Productive real assets keep you alive economically. Export-linked cash flows keep you liquid. Miss one layer, and you are exposed. But there is still a phase that investors rarely prepare for. The moment when banks stop functioning as intermediaries altogether, when payments fail, when credit becomes a memory, when survival is no longer about portfolios but about transaction capability. That is where things become uncomfortable very quickly. The day the banks closed in Beirut, it did not feel like a crisis. It felt like a holiday. The signs on the doors were polite. Temporary measures. ATMs still worked, but only for small amounts. Transfers were delayed, then reviewed. People went home believing the system would reopen after the weekend. It never really did. This is the phase most investors never model. Not depreciation, not inflation, functional failure. When banking freezes, the economy does not stop. It reroutes. What matters is not net worth, but transactionability. Who can pay, who can receive, who can move value without permission. In Weimar's final months, barter reemerged not out of nostalgia, but necessity. Coal miners were paid in coal. Factory workers were paid in bread. Municipalities accepted taxes and goods. Money became a voucher of last resort. In Zimbabwe, fuel coupons, mealie meal, and foreign cigarettes became transactional instruments. In Venezuela, phone minutes, gasoline, and imported medicines replaced cash. In Lebanon, fresh dollar traded at a premium to digital ones. The unit of account fractured. This is where tactical assets matter. Small denomination stores of value that can bridge transactions. Items that are standardized, divisible, and immediately useful. Not for speculation, but for continuity. Gold re-enters here in a different form. Not bars and vaults, but coins, jewelry, fragments, things that can settle a trade without negotiation. Alongside it sit necessities with shelf life, fuel, food staples, medicine. In every collapse, these become parallel balance sheets. What fails catastrophically at this stage is everything dependent on centralized trust. Long-duration bonds go to zero in real terms. Insurance contracts evaporate. Pension promises become political liabilities. Bank equity is not restructured, it is erased. I call this the zero list. Assets that do not decline gracefully. They simply stop. The psychological mistakes people make here are predictable. They wait for official reopening. They believe access will return because legality demands it. They refuse to convert digital claims into physical reality because doing so feels extreme. By the time they act, spreads have exploded and substitutes are gone. I watched this in Argentina when correlative restrictions were imposed. Those who converted early paid a premium. Those who waited paid multiples or lost access entirely. The cost of hesitation compounds faster than inflation. Another mistake is overconfidence in sophistication. Complex instruments become useless when clearing systems fail. Simplicity wins because it works offline. This is not regression. It is adaptation. There is also a moral illusion investors carry into this phase that doing nothing is safer than acting. It is not. In a freezing system, inaction is a position. It is a leveraged one. This is where capital survival intersects with personal psychology. The calm investor does not panic, but neither does he freeze. He reduces dependency on any single channel. He diversifies access, not just assets. In every collapse, those who maintained optionality slept better. Multiple accounts, multiple forms of value. Multiple ways to transact, not paranoia, redundancy. What I want you to understand is this. By the time banking freezes, the crisis is mature. The signals were there months or years earlier. Yield curves distorted, capital controls whispered, liquidity injections normalized. The freeze is not the beginning. It is the consequence. If you have prepared correctly, this phase is uncomfortable but navigable. If you have not, it is humiliating and permanent. The final chapter is where everything converges: allocation, warning signs, and the question every skeptic asks me privately: what if I am wrong? That question deserves a serious answer because risk management is not about certainty. It is about asymmetry. March 16, 1923. Berlin. I return to Friedrich Miller's story because it anchors everything we have discussed. By this date, the market had lost any connection to reality. Friedrich's savings were gone. His wages could not buy bread. Yet, across town, a small group of gold holders, a few farmland operators and merchants who had diversified their forms of payment were quietly functioning. Not rich, not celebrated, but alive, functional, flexible. That is the essence of survival. First, hard money, gold. Physical, liquid, decentralized. It is the foundation, enough to preserve purchasing power, but not so much that it limits operational flexibility. Gold is insurance, not speculation. Second, productive real assets, food-producing land, energy assets, and basic commodities. These are not paper claims or derivatives. They generate essential goods and cash flow during systemic distress. Ownership here is about operational control, not market timing. Third, export-linked cash flows, businesses and assets whose income is tied to functional currencies while costs collapse locally. These create asymmetry. They benefit from the local currency's decline without relying on government permission. Fourth, tactical liquidity assets for banking freezes, coins, small denomination of gold, foreign cash, fuel, medicine, and other transactional necessities. These are bridges across a failing system. They allow you to operate while others are immobilized. Allocation is nuanced. It is not a static percentage. It is structural. A crisis may compress some layers and expand others. Flexibility is more important than precision. The key is to ensure survival at each stage we have outlined: early collapse, accelerating depreciation, currency disintegration, and banking paralysis. Today, the signals are present. Excessive debt relative to GDP. Central banks buying their own bonds. Negative real yields across major markets. Velocity surges that are hidden by credit expansion. Currency mismatches in emerging markets. Policy innovations that replace solvency with liquidity. Most investors dismiss these as technicalities. I do not. History teaches that technicalities become catastrophes. What if I'm wrong? Every prudent investor asks this. The answer lies in asymmetry. Gold does not collapse overnight. Real assets maintain value even in deflationary episodes. Tactical liquidity allows operation across multiple contingencies. The cost of being prepared is minor relative to the risk of being caught unprepared. Risk management is about protecting the tail, not chasing the median. The final lesson is psychological. During collapse, fear is predictable. Panic is a function of surprise. The prepared investor is unemotional because he is structured for inevitability. Most ruin themselves not with mistakes, but with delayed reactions. Courage is not a matter of heroics, it is a matter of prior positioning. Return to Friedrich. Imagine him with the knowledge we now have. He would have diversified into hard assets. He would have acquired productive goods. He would have maintained liquidity independent of banking systems. He would not have panicked because he understood the stages. This is the blueprint for survival. The crisis is not theoretical, it is happening quietly. By the time it reaches headlines, the optimal window has passed. Act with precision, discipline, and calm urgency. Preserve purchasing power. Own functional assets. Maintain transaction capability. Observe history. Recognize patterns. Prepare before the collapse is visible to everyone else. History does not repeat exactly, but it rhymes with precision. Those who recognize the rhythm act early and maintain structural integrity survive. Those who wait for certainty lose everything. Remember Friedrich and ask yourself, where will you be when the system stops recognizing numbers as value? The choice is yours. Act now before trust evaporates.